You've heard it a million times, renting is just throwing money away. But is it really? Or could buying a house be the biggest financial trap you fall into? It's a confusing question because both sides have a point. In many major US cities, it can be cheaper month to rent than to own. Yet at the same time, stats show the average homeowner has a net worth over 40 times higher than the average renter. Now, both of those statements are technically true, but they also come with huge asterisks. That net worth gap, for instance, has more to do with the fact that homeowners are typically older and have higher incomes than it does with the magic of owning a home. So, what's the real story? Today we're skipping the opinions and doing the actual math. Meet Derek and Nathan. They're the same age, have the same job, and they've both saved up $70,000. Nathan is about to buy a house. Derek is going to keep renting and invest the difference. We're going to follow them for the next 30 years and track every single dollar, every mortgage payment, every rent hike, every broken water heater, and every stock market gain to finally figure out who actually comes out ahead. Let's set the scene. Derek and Nathan live in a decent-sized city, not crazy expensive like San Francisco, but not the cheapest place in America either. Nathan finds a starter home he likes and pulls the trigger for $350,000. He uses his entire $70,000 in savings for a 20% down payment. This is a smart move that lets him avoid private mortgage insurance, which is an extra fee for buyers who put down less. His loan is for the remaining $280,000. For our model, we'll say he gets a 30-year fixed-rate mortgage at 6.5%, a plausible rate for our example, though real-world rates are always changing. This brings us to the first number that trips everyone up, the monthly payment. Nathan's principal and interest on the loan is fixed at about $1,770 a month, but that's not his real total. He also has to pay property taxes and homeowners insurance, which get bundled into his payment. Let's say those add another $830 a month. So Nathan's all-in housing payment, his PITI, is around $2,600. Meanwhile, Derek finds a comparable apartment and signs a lease for $2,000 a month. He takes his $70,000 in savings, the same money Nathan used for his down payment, and puts it into a low-cost stock market index fund. And since his rent is $600 cheaper than Nathan's total house payment, he commits to investing that $600 difference every single month. The race is on. Nathan has a home with a $2,600 monthly payment. Derek has a $2,000 rent payment, a $70,000 investment portfolio, and another $600 flowing into it every month. The first few years of owning a home can be a bit brutal, and they reveal a hard truth about how mortgages work. In year one, Nathan makes $31,200 in total house payments. But when he looks at his mortgage statement, he gets a shock. Out of all that money, only about $3,100 went to paying down his loan. The vast majority, over $18,000, went straight to the bank as interest. That's amortization in a nutshell. In the early years, you're mostly just paying for the privilege of borrowing the money. Then come the joys of ownership. In year two, the water heater gives out. That's a $1,400 surprise bill. In year three, a storm messes up his roof, and that's a $2,900 repair. These aren't fun upgrades, they're must-dos. People often suggest budgeting 1% of the home's value for annual maintenance, but that's just a rough guideline. Some years you get lucky, some years a hailstorm has other plans. For Nathan, that's another $3,500 a year, or about $300 a month he should be setting aside. And remember that fixed payment. The loan part is fixed, but taxes and insurance aren't. After a citywide reassessment, his property taxes tick up and his insurance premium climbs, adding another $50 to his monthly bill. So where are they after 3 years? Let's assume Nathan's home has appreciated at a modest 4% a year, a reasonable long-term average, though it can vary wildly. His $350,000 house is now worth about $394,000. His mortgage balance is down to about $270,000. That leaves him with $124,000 in equity, on paper. And on paper is the key phrase here. What about Derek? He's been quietly renting and investing. His initial $70,000 plus the $600 a month has been growing. If we assume a 10% average annual return from his index fund, another long-term market assumption, his portfolio is now worth about $118,000. At first glance, Nathan's $124,000 in equity looks better. But that equity isn't cash in his pocket. To get it, he has to sell the house. And selling is expensive. Think real estate commissions and closing costs, which can easily eat up 6% to 8% of the sale price. If he sold today after paying those fees, he might walk away with less cash than what Derek has in his investment account. This is why you often hear that you need to stay in a home for at least 5 years just to break even on the costs of buying and selling. Flash forward to year 15. This is where the story starts to pivot, and the biggest advantage of a fixed-rate mortgage begins to shine. Over 15 years, let's assume Derek's rent has gone up by an average of 3% a year. This is a key detail many people forget. His initial $2,000 rent has now crept up to about $3,100 per month. It happens so slowly you barely notice, but the effect over time is huge. Nathan, on the other hand, is still paying the exact same $1,770 in principal and interest he locked in 15 years ago. Sure, his taxes and insurance have gone up, and his total payment might be closer to $2,900 now, but Derek's rent has completely passed it. Nathan's payment has become an incredible shield against inflation. So let's check the scoreboard. Nathan's house, if it kept appreciating at 4% a year, is now worth around $630,000. After 15 years of payments, his loan balance has dropped to about $207,000. That leaves him with a massive $423,000 in home equity. Of course, he's also spent a cumulative total of around $52,000 on maintenance over that time, using our rough 1% rule. Now, what about Derek? Let's assume he stayed disciplined. His initial $70,000 and his steady $600 monthly investments have had 15 years to grow. Assuming that 10% market average, his portfolio is now worth approximately $515,000. So, at the 15-year mark, Derek, the renter, is actually ahead in terms of pure net worth. His wealth is also completely liquid. He could sell it all tomorrow. Nathan has built an incredible amount of forced savings, but his net worth is tied up in his house. Derek has flexibility. Nathan has stability. 30 years have passed. Derek and Nathan are now in their late 50s and thinking about retirement. How did it all play out? Let's start with Nathan. He makes his 360th and final mortgage payment. He's done. He owns his house free and clear. That's a powerful feeling. With 30 years of 4% appreciation, his home is now worth about $1,135,000, and it's all his. His monthly housing costs have dropped off a cliff. With no more mortgage, he just has to pay taxes, insurance, and maintenance, which might be around $1,500 a month. He has a paid-for roof over his head for life. Now for Derek. This is where his story reveals the so-called fatal flaw of the renting strategy. It requires incredible, lifelong discipline. Let's imagine a realistic scenario. Derek was diligent at first. He invested his $70,000 and the initial $600 monthly savings. But as life got more expensive and his rent kept climbing, he never increased his investment amount. After 30 years, assuming a 10% average return, his portfolio is worth about $1.4 million. That's amazing. But here's the catch. After 30 years of 3% annual increases, his rent is now a painful $4,850 a month. He's a millionaire on paper, but he's facing a massive unending bill that will keep rising for the rest of his life. Now, what if Derek was a hyper-disciplined financial machine? What if every time his rent went up, he recalculated the savings between his rent and Nathan's housing cost and invested that growing surplus? In that case, his final portfolio would be even bigger, likely closer to $1.7 million. So, who won? In both scenarios, Derek has a higher net worth. But Nathan has something Derek will never have: housing security. Nathan's $1.1 million asset also provides him with shelter at a low fixed cost. Derek has more money, but he's still a player in the rental market game, forever. If the math can work out for both of them, how are you supposed to decide? The answer isn't just about discipline. A great place to start is with one simple, powerful number: the price-to-rent ratio. The formula is easy. Take the median home price in your city and divide it by the median annual rent. The number you get tells you at a glance which option is likely cheaper in your specific area. Here's a general framework people use. A ratio below 15. Buying is heavily favored. Ownership is cheap compared to renting. Historically, you might see this in cities like Detroit or Cleveland. A ratio of 16 to 20. This is the gray area. The math is close, so the right choice depends more on you, how long you plan to stay, your job stability, and if you enjoy weekend trips to the hardware store. Cities like Denver and Phoenix often land here. A ratio of 21 or higher, renting and investing the difference looks much stronger here. Homes are very expensive compared to the cost of rent. This is common in places like Los Angeles, Boston, and San Jose. Now, this ratio is a starting point, a useful heuristic, not an ironclad law. It doesn't factor in mortgage rates, property taxes, or how long you plan to live there. But it's probably the best tool for cutting through the noise and starting with data instead of emotion. In our story, Derek and Nathan's city had a ratio of about 18, putting them right in that toss-up zone where either path can be a winner. So, is renting just throwing money away? No. You're paying for a place to live, plus flexibility and freedom from surprise repair bills. Is buying a house a golden ticket to wealth? Not necessarily. It's a form of forced savings that anchors you to a location and comes with its own major costs and headaches. The truth is, both paths can lead to wealth, but they demand different things from you. Buying a home forces you to save. It's a slow and steady investment that gives you a stable housing cost that doesn't go up with inflation. Renting optimizes for flexibility. It keeps your options open, and if you have the discipline of a financial samurai, it can leave you with a larger, more accessible pile of cash. The problem is, most people just aren't that disciplined for 30 straight years. The right choice isn't the same for everyone. It depends on your career, your personality, your timeline, and most importantly, the real math in your specific city.